So I did this video in August of 2021, so a couple years ago, and I predicted that bonds were going to crash. Now we've seen bond values just take a plummet, right? You can see on this ETF, the 20-year bond iShares ETF went from $180 down to about $90 now. So that was from the peak of the mid-2020s to about $90. So how did I know this was going to happen? Well, it's pretty obvious to me because of what the Fed had positioned to say they're going to do. But now things have changed, right? So could bonds actually be a great investment? I'm going to jump into that. If you own bonds, you're interested in owning bonds, you're looking for fixed return or safe return, then this video is for you. I'm going to go over this in 3 easy points. We're going to jump in. Let's do it. All right, my name is Bronson Hill. I'm the CEO of Bronson Equity. We have about $200 million in multifamily apartments, as well as other investments such as ATM machines and car washes and oil and gas. We help investors get predictable passive cash flow. We love talking about macroeconomic topics like this and talking about different assets that are not things we do, because the question always comes down to compared to what, right? If you're an investor, you're looking for cash flow, you're looking for appreciation, you're looking for tax benefits, you're looking for what you're looking for. There's many different assets that could probably do that for you. So that's where it's important to look at it. I'm not an investment advisor, and so get your own independent advice. These are just my opinions. So let's talk about this. What are the benefits of bonds right now, right? So you can see this chart. Really interesting, shows that going after years of 0% interest rate and super low bond returns, we're finding that the 3, 6, and 12-month treasuries are returning over 5%, right? And it's higher, kind of the shorter. I think the max there is in the 6-month. And then as you get to longer, over the 30-year, it gets down to in the 4% range. Why is this? Why have bond yields come up? Well, the expectation, though, and this is called an inverted yield curve, right, where the short-term bonds are paying more than the long-term bonds. People are, and even the market's expecting that rates will not stay this high forever. The Fed has signaled that they're going to have, rates high like they are right now. They've come up, from almost 0% to 5 to 5.5%, which is a substantial raise in a very short period of time, about 18 months. So it's put a lot of pressure on different types of investments. But this is the interesting thing about bonds. This is kind of why I like them right now, right? Is that there's stuff it has returned nothing, right? Things in bank accounts, and now we're seeing yields in bank accounts. We're seeing yields in bonds, and after these years of 0% yield, we're actually seeing some returns here. Now, there is a relationship too, where as the value of bonds rise, old bonds that you've had, the value of those goes down. Now, the reverse of that is true. So right now, bond values are higher. They're expecting that interest rates are going to stay high, and then they'll start kind of coming down. And when that happens, people can make a lot of money, because if you have a 5% bond or a 4.5% bond, and it's a longer, maybe 5, 10, 20-year or 30-year bond, what will happen is as newer bonds are issued that are 3% or 4% or less, what will happen is the value of those bonds with the higher coupon is worth more, right? So this is something that actually gives an advantage. There's some investors that did very well from when bonds were actually in 1980. There were some long-term, 30-year, 20-year bonds that were paying close to 20%, which is outstanding, right? And then as the rates dropped and bonds started paying in the single digits, those older bonds that had the higher coupon rate were worth way, way more. That's kind of how the valuation goes with bonds. So there's some opportunity right now that if you buy, you not only get the return, you also potentially get some upside as rates, start to drop in the future. So this is really the biggest thing about bonds as well, I found, is that there is a fair amount of capital preservation. So for some people, if you need like less volatility, there's no leverage in there. And the other investments, we've just seen volatility, right? We see lots of volatility in the stock market, even in real estate, we've seen volatility because there is interest rate, there's leverage involved. And so those are all things to consider. Now, this is personally, I'm going to just basically contradict everything I said for me personally, right? So this is why I don't buy bonds. Now, I'm not saying you shouldn't, I'm just saying this is why I don't buy bonds. And I want to share because everybody's different, right? So everybody has different goals, right? So if I'm somebody's a little younger, I'm 42, I have a long investment horizon, I'm in assets that, maybe there's on paper more risk, but there's a lot more upside potential. Those are things that I look at. If somebody's older, they have more of a fixed income need, they can't handle the volatility, it can make sense. So to me, personally, I found that bonds typically don't keep up with inflation, right? They don't keep up with, if there's, inflation, they're saying right now, and this is the Fed came out, and this is just kind of really funny to me. It probably shouldn't be this funny, but came with a statement saying, hey, congratulations, inflation is only 3%, right? So it's only 3%. We're almost at 2%, we're out there. And I'm thinking like, how in the world is it only 3%? Now, inflation generally goes down in recessions. We're in a recession, around a recession. But basically, if inflation is 3%, then things are not as bad as what we thought they've been, right? But I think most people, as we go to the store, we do have different expenses. We realize inflation is still very high. And even if it is 3% now, it wasn't 3% from a year ago, it was 9% or higher. So ShadowStats still has inflation. You can see this chart between 10 and 12%. So we're still seeing some pretty high inflation, right? So I like to have investments that really keep up with inflation. And what that means is your returns have to be higher than the actual inflation, not the stated inflation, right? So if your returns are actually something more like above 10, 12%. So we've got one of the deals that I love, the ATM machine investment that we do, is well north of inflation, right? So it basically has a much higher return than inflation. So I found things that will keep me ahead of inflation. And the question is, if inflation is 3%, then why are these even shorter or midterm bonds paying over 5%, right? That just doesn't make any sense why that would happen. So I think that's something to consider. That's really why I don't buy bonds. Now, again, this is the bottom line for bonds. And again, if you are somebody, again, this is your story, this could make sense for you, right? If you're somebody who's older, you're somebody who's, maybe closer to retirement or in retirement, you need something that's a little more fixed. And also you have less risk tolerance, meaning you can't handle the volatility either from a personality perspective or just a timeline perspective. Hey, if you're in your 60s or 70s, it may not make sense. Just like, hey, can I handle something that's a little more fixed? And I really need that. And then there's a preservation, like we talked about. There's actually a growth in value if the yields start dropping. You've got a higher rate, you're locked in for a longer time, and so there could be some upside there. And it's good if you don't know what you're doing. I'm going to qualify this. I'm not saying you're not a smart person, you don't know what you're doing, but it does allow you to diversify and get into something that's solid if you don't quite know what to do, right? And that's even like Buffett has something like $100 billion invested in short-term treasuries, 3 and 6 months treasuries, because it's a good return. Hey, if I'm just sitting waiting, I'd rather have it in there and while I'm waiting than kind of doing something else, right? So there is some wisdom there as well. This kind of depends where you fall on the spectrum. But it really won't be good for others because it is below the rate of inflation and it's lower returns than other investments. So I'd love to know from you, what do you think? There's going to probably be some strong opinions here. You may have some strong opinions, think I absolutely agree, I absolutely disagree. Let's get it going in the comments. I'd love to hear from you what you're thinking about bonds right now, because I think there is some opportunity there. It is getting interesting. So I want to share this with you. This comes from Bill Gross, who is known as the Bond King. There's a book I read about him called The Bond King. Made tons of money between 1980 all the way up to a few years ago when bonds just had this huge bull run where, again, the rates, the yields were very high and they started coming down slowly over time. And that's just a beautiful recipe for a bond investor. So he said this, he said, bond investors are the vampires of the investment world. They love decay, recession, anything that leads to low inflation and the protection of the real value of their loans. So that's interesting, right? So when things don't go well, if you have bonds typically are more the fixed way, and then the value will increase over time. And this is why they call them the investment vampires. I think that's really good. They're going to suck the blood right out of the economy or out of the investment world. So I want to share this video with you. I feel like a lot of wealth has to do with mindset. I've been able to quit my great corporate job, able to 20x my net worth. I did this through really developing a different mindset around wealth and money. So this video is called Think Rich, Get Rich, and it's over here. I had some really good feedback on it. Love for you to check it out and see what you think. If you haven't joined our investment club, consider joining. We've been doing, like I mentioned, deals in multifamily, oil and gas, ATM machines, car washes, and other sorts of alternative investments. We have, regularly have new deals coming out. We're really excited about them. So thanks for taking the time to educate yourself. I look forward to seeing you on the next episode.